If you zoom out for a second and just look at your own life, it's kind of weird, right? Like you're just trying to do the responsible thing. You're putting money into your 401k. Maybe you've got a Roth IRA. Maybe you're dollar cost averaging into index funds every month. You check your portfolio a little too often, even though you promised yourself you wouldn't, and some days it's up, some days it's down. And lately, it feels different. You open the news and it's war headlines, missile strikes, escalations, alliances being tested, sanctions, oil spikes, politicians using phrases like serious consequences and red lines. And you're sitting there thinking, okay, should I be doing something? Should you move to cash, buy gold, sell everything, buy defense stocks, or just ignore it and hope it blows over? It's this weird low-grade anxiety that just sits in the background while you're trying to live your normal life, go to work, pay bills, build wealth, plan retirement. And honestly, I get it. My name is Tim, and I spend way too much time thinking about money, not just investing mechanics, but the psychology of it, why markets react the way they do, why fear spreads faster than facts, why some people panic and blow up their portfolios while others quietly get richer during chaos. And over the past few years, with everything happening globally, I've found myself asking the same question you probably are. Are we actually closer to World War III? And more importantly, what does that mean for your money? Because here's the thing nobody says clearly enough. Whether or not we're on the brink of a global conflict, the fear of it alone can move markets, crash portfolios, spike inflation, and completely change your financial trajectory if you're not prepared. By the end of this, you're going to see global conflict differently, not as a headline, not as doom, but as a financial variable, a risk, a cycle, something you can understand and position yourself around. And honestly, that perspective shift alone can change everything.
Let's start with something important. Markets don't wait for war to happen. They react to the possibility of war. There's something called a risk premium. Basically, when uncertainty rises, geopolitical tension, military mobilization, sanctions, investors demand higher returns to compensate for risk. And how do markets create higher returns? Prices drop. It's not always dramatic. Sometimes it's subtle. But when headlines escalate, volatility spikes. The VIX jumps, defensive sectors outperform, money moves. Think about it like this. Imagine you're about to board a plane, and you hear there might be mechanical issues. You don't wait for the engine to fail mid-air to feel nervous. The possibility alone changes behavior. Markets work the same way. Historically, before major conflicts, markets often dip. But here's the part people forget. Once uncertainty clears, even if war actually begins, markets frequently recover faster than expected. Why? Because clarity, even bad clarity, is easier to price than uncertainty. Why this matters to you: if you panic and sell during uncertainty, you lock in losses. If you understand that markets front-run fear, you can avoid making emotional decisions. Actionable takeaway: if you're long-term investing, don't react to headlines, react to fundamentals. And remember, volatility is not the same as permanent loss. Sometimes it's just the fear premium playing out. Okay, let's talk about oil, because honestly, oil is usually the first domino. When global tensions rise, especially in regions critical to energy supply, oil prices spike. And when oil spikes, everything else follows. Transportation costs rise, manufacturing costs rise, food prices rise. Inflation creeps back in. And if inflation comes back, central banks hesitate to cut rates. And if rates stay higher for longer, growth stocks feel pressure. Housing slows. Debt becomes more expensive. See how this cascades? It's not just war, it's a chain reaction. There's a reason energy markets react instantly to geopolitical tension. Energy is the bloodstream of the global economy. Now here's where it gets interesting for investors. Energy stocks often benefit during early-stage conflict fears. Defense contractors may see increased attention, commodity producers gain leverage. Meanwhile, rate-sensitive sectors can struggle. But here's the nuance. By the time retail investors pile into war trades, a lot of the move has already happened. So what do? You don't chase spikes. Instead, you ask, is my portfolio diversified across sectors? Do I have some exposure to real assets? Am I over-concentrated in one narrative? Sometimes the smartest move isn't buying something new, it's making sure you're balanced.
One of the biggest financial risks of escalating global conflict isn't bombs, it's inflation. If supply chains get disrupted, shipping lanes blocked, manufacturing hubs destabilized, goods become scarce. Scarcity drives prices up. We already lived through a supply shock recently. Remember empty shelves, used car prices going insane, groceries jumping every week? Now imagine that layered with geopolitical instability. Here's why that matters. Inflation erodes purchasing power quietly. It doesn't crash your portfolio overnight. It slowly eats your savings. If you're holding large amounts of cash during a prolonged inflationary period, you're technically losing money in real terms. So what's the move? Own productive assets. Stocks, real estate, businesses, things that can adjust prices with inflation. Historically, equities have outpaced inflation over long time horizons. Not every year, not smoothly, but consistently over decades. Personal reflection moment. Honestly, inflation scares me more than market crashes. Crashes are loud, inflation is quiet. And quiet financial erosion is harder to notice until it's done serious damage. Let's address something uncomfortable. Whenever conflict escalates, defense stocks get attention, and investors face a weird emotional dilemma. Is it wrong to profit from war? That's a personal decision. I won't moralize here. But financially speaking, defense spending tends to increase during periods of tension, sometimes even before active conflict begins. Governments ramp up contracts, production increases, budgets expand. That can translate into earnings growth for companies in that sector. But here's the caution. Defense stocks are cyclical. They often spike on headlines and cool off once budgets normalize. So again, don't chase emotional trades. If you want exposure, keep it proportionate. Make it part of a diversified strategy, not a reactive bet. Because emotional investing, even when driven by fear or outrage, rarely leads to consistent returns. When global conflict fears rise, capital looks for safety. And historically, the US dollar strengthens during global crises. Why? Because investors seek stability, liquidity, and strong institutions. Money flows toward perceived safe havens, US treasuries, the dollar, sometimes gold. Gold is interesting. It's psychological. It doesn't produce cash flow, but it represents stability, scarcity, tangibility. During intense uncertainty, gold often rises. But long-term, equities tend to outperform gold significantly. So what's the balance? You don't need to go full bunker mode and convert your portfolio to gold bars. But modest exposure to diversifiers, commodities, international assets, bonds, can smooth volatility. Again, balance beats extremes.
Here's the uncomfortable truth. The biggest financial risk during geopolitical tension isn't World War III. It's you. It's panic selling at the bottom. It's going all in on one narrative. It's doom scrolling yourself into bad decisions. Behavioral finance studies show investors underperform the funds they invest in because they buy high and sell low. Fear amplifies that. When headlines scream escalation, your brain switches into survival mode. Logical thinking drops. Urgency rises. But investing rewards patience. If you zoom out historically, markets have survived world wars, cold wars, oil shocks, pandemics, terrorist attacks, financial crises. And over time, they've trended upward. Not because the world is stable, but because productivity, innovation, and human progress continue. That's the long-term bet you're making when you invest. Okay, let's not avoid it. What if there really is a massive global conflict? In extreme scenarios, markets would drop, volatility would spike, certain sectors would collapse, others would surge. But here's something important. In true catastrophic global war, your brokerage account is not your biggest problem. That sounds dramatic, but it's perspective. Financial planning works within probabilities. You prepare for recessions, inflation, volatility, things that historically happen. You don't build your entire strategy around apocalypse scenarios. Instead, you build resilience, emergency fund, low debt, diversified portfolio, long-term horizon. That's how you hedge uncertainty, not by predicting the future perfectly, but by being financially anti-fragile. So, are we closer to World War III? Maybe, maybe not. Geopolitical tension ebbs and flows. Headlines intensify, then cool, then flare again. But here's what matters more than predicting global conflict: understanding how markets process fear, recognizing inflation risk, staying diversified, controlling your behavior, thinking long-term. Because honestly, the investors who build real wealth aren't the ones who perfectly time geopolitical events. They're the ones who stay rational when others panic. They see volatility not as doom, but as part of the process. And if you can internalize that, if you can look at a scary headline and think, okay, how does this actually affect cash flows, inflation, rates, and long-term growth? You've already separated yourself from most investors. We can't control geopolitics, but we can control our allocation, our discipline, our reaction. And in the long run, that control is what compounds. Not fear, not headlines, not panic, just steady, boring, rational decisions made consistently, even when the world feels unstable.
And let me add something else that doesn't get talked about enough. There's a difference between preparing and obsessing. Preparing looks like tightening up your emergency fund, maybe adding a little more diversification, paying down high-interest debt, making sure your investments actually match your risk tolerance. Obsessing looks like refreshing the news every 12 minutes and rearranging your portfolio every time a politician clears their throat. One builds resilience, the other builds stress. And stress is expensive. It leaks into your decisions. It makes you reactive. It makes you feel like you have to do something, even when the best move is to sit still. Sometimes the highest return decision is the one that feels the most boring. Just staying invested, just sticking to the plan. That's it. Another thing to think about is time horizon. If you're 25 or 35 and investing for retirement that's decades away, a geopolitical shock today is, statistically speaking, a temporary event inside a very long compounding arc. But if you're 5 years from retirement, the strategy shifts. It's less about maximizing upside and more about protecting downside. That's not fear, that's alignment. Your portfolio should reflect your timeline, not the headlines. And honestly, this is where having a written plan changes everything. When markets drop 15% on escalating conflict fears, you don't want to decide what to do in that emotional moment. You want to look at a pre-made rule and say, oh right, I rebalance when equities fall below X%. I keep 6 months of expenses in cash. I don't sell unless my thesis changes. Rules beat feelings, every time. There's also opportunity hiding inside chaos. Corrections, even scary, headline-driven ones, are often when long-term investors quietly accumulate assets at better prices. It doesn't feel good in the moment. It feels reckless. But historically, periods of maximum uncertainty have planted the seeds for future returns. That doesn't mean you go all in recklessly. It means you keep deploying capital methodically, even when your stomach tightens a little. And here's a small personal observation. When global tensions rise, I notice how quickly conversations shift from long-term goals to short-term survival. People stop talking about retirement freedom and start talking about worst-case scenarios. That shift in focus alone can derail years of disciplined investing. Your job is to zoom back out, to remember why you started investing in the first place. Financial independence, flexibility, security. Those goals don't disappear just because the news cycle gets louder. If anything, uncertainty is the reason to build wealth. A strong balance sheet, low debt, solid savings, diversified investments gives you options when the world feels unstable. Options to relocate, to change jobs, to help family, to weather inflation. Money isn't just about returns, it's about resilience. And resilience matters more during uncertain times than during calm ones. So instead of asking, are we closer to World War III? Maybe the better question is, if volatility spikes tomorrow, am I financially positioned to handle it? Because that's actionable. That's within your control. And once you shift your focus from predicting global outcomes to strengthening your personal foundation, the fear gets quieter, not gone, just manageable. And that's enough to keep compounding. And honestly, that might be the real edge.